I have rates going down from here for the next 18 months. It'll start gradually, but ultimately, like I said, you could get 10-year down to zero. And that first move down, let's say from 460, 70 area down below four, I think is going to help gold. Will That'll be trading down well. The rates will be trading down well while gold's moving up and silver's moving up. And then I think you can get a faster move from there down to three or even below. That will be kind of that final move up towards those numbers. And as I said, I can only get to 7,000 on gold and 200 on silver, but it won't surprise me if those numbers prove conservative.
Global macroeconomic trends indicate severe structural shifts across sovereign debt, central bank policies, and precious metals markets. Capital allocators face unprecedented volatility as shifting yields trigger massive liquidity reallocations worldwide. Tracking key macroeconomic indicators has become essential for long-term wealth preservation. David Hunter, a veteran macroeconomic strategist and cycle analyst, maintains that interest rates have peaked and will decline over the next 18 months, ultimately driving the 10-year Treasury yield towards zero. This impending easing cycle serves as a major bullish catalyst for commodities. Gold is targeted to surge to $7,000, while silver is projected to reach $200 in the current cycle. Concurrently, the US dollar index is projected to break down toward 83 within 6 to 9 months, further reinforcing this historic upside. These price targets could ultimately prove conservative as easing accelerates. Now, we present the clips from David Hunter's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I can't get there myself to Michael's numbers, but I don't think he's crazy, and I certainly don't discount his experience and knowledge. And it's certainly possible it exceeds my expectations for this cycle. But right now, 200 is as high as I can get, and I raised it. I had it at 125, I think, going into January, and then raised it to 170, I think, and then raised it again to 200 at the end of May. So, but that's I'm pretty confident with the 200. I just can't get to the 3, 4, 500s that Michael's talked about, and certainly not 1,000. The 1,000 for me is probably a 2032 or three type period, but you can drive a truck through how much you can miss that by. It could be 2 years either way, but if it's the next cycle really getting driven, and it comes from a lower level in the bust, I do think the metals will, as they always do, get hit in a big market correction, in a recession, or what in this case is a bigger than recession type downturn. But those that are very turned off by the fact that silver got to 122 and rolled over and has been down for months, and it shook out a lot of weaker hands. As you know, because we've talked about this for years, I was bullish on silver and gold, 2, 3, 4 years ago, and it took a while to get going. Gold got going before silver, but silver, I took a lot of heat because when it was in the mid 20s and just couldn't get out of its own way. It was trade, and particularly the miners, but between mid 20s and the high teens, and then it got up to 30 and then backed off again. People just didn't believe that it had the kind of legs that I talked about. And then when it finally broke out and took off, that's when people jumped on the bandwagon. So they didn't buy it at 30 or 40. They bought it at 60, 70, 80. And then they're really upset because they lost money. But that's markets. Once things get too ebullient, the market has a way of basically bringing back the discipline, shaking out the weak hands. And because the run from 50 to 122 was parabolic and happened so dramatically, it took months to correct. And I can say that looking back, I didn't know that it was going to take 6 or 8 months to get going, but I'm confident now that 55, 6 level was the correction bottom, and that we have begun the turn. And obviously today it's coming out of a little bit of a pullback yesterday, and it looks like it can go higher. There's still going to be pullbacks. It's still going to be, you have to be careful with it. But I do think once it breaks above a certain level, and I'm not sure whether that's, I see 72 right now as the next stop, but I know Michael's probably talking higher than that. But there'll be corrections along the way, but I don't think they're going to be long lasting. They might last days, but not months. If you price gold in various currencies, you'll see differences in returns because currency matters. Obviously, the dollar in the last year has been up, and yet gold had a nice run. So it hasn't been the case near term, but I do think the big move from 4,500, 44,500 here to 7,000, a lot of that is going to be currency. I mean, I have the dollar going to 83, something like that, over the course of the next 6 or 9 months, or less. And if that happens, it's a big part of the move to 7,000, I think. It's more than that, though. Obviously, rates coming down, which, as I said, I think rates peaked yesterday. I don't usually try to call things to the day, and I didn't call it, but I mean, I don't usually pinpoint things like that. But it looks to me like you finally got to max bearishness, and then obviously what Besant announced today, helps. But I have rates going down from here for the next 18 months. It'll start gradually, but ultimately, like I said, you could get 10-year down to zero. And that first move down, let's say from 460, 70 area down below 4, I think is going to help gold. That'll be trading down well. The rates will be trading down well while gold's moving up and silver's moving up. And then I think you can get a faster move from there down to 3 or even below. That will be kind of that final move up towards those numbers. And as I said, I can only get to 7,000 on gold and 200 on silver, but it won't surprise me if those numbers prove conservative.
Global markets are heading toward a devastating liquidity crunch that threatens to eclipse the fallout of the 2008 financial crisis. Facing total collapse across the banking sector, international central banks will unleash historic quantitative easing, with the Federal Reserve pumping trillions of emergency capital into the system to prevent a systemic breakdown. This credit event will trigger a severe multi-stage market contraction, ultimately ending the dominant 44-year secular bull run. While aggressive intervention may spark an explosive initial relief rally, equities will struggle to sustain previous valuations under intense macro stress. Investors relying solely on traditional buy-and-hold models risk extensive drawdown as long-term market dynamics fracture. Now, let's get back to the interview.
I'm calling for a global bust, which I believe is something bigger than 2008-9 in terms of credit crisis. There's only one thing that's the most predictable thing in my forecast is how central banks and policymakers will respond. They won't have a choice. If you ask them today, they'd say, no way, we're not doing that. But they won't have a choice when the financial system is free falling. You will see money coming out of every corner of every central bank, to the tune of, I think, for the Fed, maybe $20 trillion, maybe more, because it's if you truly have a free falling financial system, we almost got there in 2008-9, pulled back from the cliff just in time. If this time we go over that cliff, there's only one thing that moves quickly, and that's liquidity in the system, printing money. So I think it's the most predictable part of the forecast is that ultimately we're going to see money like there's never been money printed before, at least in the world. And that means, you will have a recovery on the other side. You will have a bull market on the other side, but it won't be a secular bull market. We will see a secular top this year, meaning highs for a long time. But if you go down 80% or anything close to 80%, and just using the S&P number I have, it's 10,000 down to 2,000. That gives you a lot of room if they're printing $20 trillion in the U.S. That gives you a lot of room for that to go 2,000 back to, let's say it goes back, you could quadruple and go back to 8,000. So I think, and then from there, and that might take a year and a half or 2 years or less, depending on how fast it happens. Um, and then beyond that, it starts, lower highs and lower lows, or at least lower highs, and then ultimately probably out in the mid 30s, lower lows. So you can have a period where you can make a lot of money, but if you just buy and hold and follow the mantra that's been in place since the mid 80s, which is that it's time in the market, not timing the market, is what makes sense. It's been the correct mantra and the correct strategy for the last 40 years. But if you follow that through here, you're digging out of a very big hole and you may not get your money back. So this idea that we always go to new highs and that if you just buy and hold and don't worry about it, passively invest or what have you, you're just going to benefit from the constant higher highs. Secular bull markets, when they're 40 years old, this one's 40 going on 44 years now, basically 44 years right now. 44 years is an eternity for most people in markets, and certainly there's an awful lot of people in these markets that weren't around 44 years ago. So it looks like you always have a bull market, a secular bull market. But I think it's coming to an end. And if it is, and if we get that bear market that I'm talking about, that buy and hold strategy is going to fail you. And then the other piece of it is every cycle, not secular, but every cycle, market cycle, is new leadership. So this one's been obviously tech and AI and some other things, but it's been very much tech. The next cycle is going to be, I think, old industrial commodity. So that the caterpillars of the world will work, the deers of the world will work, but so will silver, gold, copper, and the producers of that. And the reason for that is because all that money that gets pumped in will, with a lag of a couple of years, jumpstart a very big inflation cycle, the likes of which we haven't seen in 50 years, basically, or 45 years, going back to the early 80s. And it will be, it'll start gradually. You're coming out of, I think the bust will be deflationary. So you're going to come out of a year of deflation. And then from there, low single digits and then high single digits. By the turn of the decade, early next decade, you'll probably be in double digits, maybe moving up towards 20 or 25% inflation. The only stocks that can outperform in that environment are stocks that have pricing power, that can produce earnings that outstrip that inflation. So it's going to get harder and harder to own growth stocks or to own slow growing, stable companies. And it's going to behoove investors to be in those things that are really moving up with inflation. I think silver can go from, I'm calling for silver now. I'm jumping ahead probably, but I'm calling for silver to go to 200 this cycle, fall back, could fall back 50, 60, 70, 75% in the bust, and then go from there. So let's say it falls back to 50. You could go from 50 to 1,000 in the next cycle. Gold could fall, I'm calling for 7,000 gold this cycle, could fall back to 3,500, 50% retracement, or 4,000. And then, I'm calling for 20,000 next cycle, probably, 2032 or 3, somewhere out there. So those are the kind of things, and copper could go to 20 or $30. Who knows? Because the demand for commodities is going to be huge, and the price. We don't have the supply. There hasn't been a lot of new greenfield production. So it's going to be a case where demand far outstrips supply. You goose the system with, let's say, 50 trillion in global money, that produces demand in those areas that are being built out, which is power and AI and reshoring here in the U.S. and et cetera. As that demands commodities in big ways, as that demand outstrips supply by a big amount, the only thing that can give is price straight up. So the point is that next cycle will be a very different cycle in terms of leadership. And those that are able to be nimble and go from today's leadership to the next cycle's leadership will be in good stead. Those that just kind of sit passively in an S&P, for example, what people don't realize is that the old leadership dominates because it moved up so much for a decade or 2 decades. It becomes the highest percentages of the portfolio, right? If you're in an S&P, because of the price moves, tech is a much bigger percentage of the S&P than our commodity stocks, certainly than our gold or silver producers. And so next cycle, if you just stay with the S&P, your weightings are all backwards. You're most heavily weighted, even with the correction, the bear market, you're most heavily weighted in those things that are going to underperform, and most lightly weighted generally in those things that are going to become the leaders. So it's again important to understand how the dynamics of portfolio work and be structured for that.
The broader macroeconomic environment is on the verge of a historic capital rotation, stripping leadership away from dominant tech and mega-cap growth equities. Massive sovereign liquidity injections will initially create a period of economic cooling before igniting persistent, double-digit systemic inflation across global economies. In this new regime, outsized performance will belong exclusively to essential industrial operators and tangible resources possessing absolute pricing power. Severe supply shortages paired with surging infrastructure demand will create structural supply-demand imbalances across key raw materials. Portfolios heavily weighted toward passive equity indices risk prolonged stagnation, making disciplined sectoral positioning critical for navigating this transition. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.